In this video, we are going to discuss certain workbook questions on marginal costing, which is released by the institute. So let's start discussing the first question. In the first question, they have mentioned annual fixed cost is 14 lakh. They have mentioned current year sales is 60 lakh and the previous year sales is 45 lakh. However, they have not mentioned the profit of the 2 year. Rather, they mentioned the change in the profit, which is 4,20,000. With this information, they are asking us to find out at what level of sales the company will break even. That is the first question. Next, at sales value of 85 lakh, what would be the profit or loss as the case may be? Last question, if the company is proposing to decrease the selling price by 10% and the company wishes to earn the same profit which they have earned in the current year, then how much quantity company need to sell? So these are the situation before us. Let's start one by one. First, to find the break-even point, I need to find PV ratio. So let's first attack PV ratio. So PV ratio, the formula is generally which we use is contribution by sales into 100. Here we cannot follow that formula for the reason they have not mentioned the selling price and variable cost. So we have to look upon the other formulas. So one of the other formula is change in profit by change in sales. Here they have mentioned the details regarding change in profit and also as well as the sales. Change in profit straight away they have given, which is 4,20,000. Change in sales we need to compute because in the question 60 lakh is current year sales and 45 lakh is previous year sales. So from that I can find out my PV ratio which turn around to 28%. Continuing further from that I can find out the break-even sales. Now what is the formula for break-even sales? It is fixed cost divided by PV ratio if I want to find it out in value. However, there is another formula for break-even point which is fixed cost by contribution per unit to find out the break-even point in units. However, since I don't have information to calculate contribution per unit, straight away we are going to apply a break-even sales value formula and find out our break-even point. Fixed cost is given 14 lakh and the PV ratio which now we have computed which is 28%. So break-even sales value becomes rupees 50 lakhs. Thus, we have solved that part of the question. Next, at the sales value of 85 lakh, what will be my profit? That is the next part of the question. Desired sales, we know the formula is desired profit plus fixed cost divided by PV ratio. Hence here, 85 lakh sales, desired sales is given. Let us put an X for desired profit and fixed cost is given which is 14 lakh divided by PV ratio which is now we have found which is 28%. Solving this, simplifying it further, we will have 28% from the RHS, it will go to the LHS. So 85 lakh into 28%. And if I take 14 lakh from RHS to LHS, minus 14 lakh is equal to desired profit. Solving this, I will get 23 lakh 80,000 minus 14 lakh is equal to desired profit. So desired profit at sales volume of 85 lakh will come to rupees 9 lakh 80,000. Next, last part of the question, where they are asking that if the company sales price fall by 10% and the company want to maintain the same profit which they have earned, for that I need to know what is the current profit, isn't it? So let's find out the current year's profit. Current year's profit, sales into PV ratio, I can if I do sales into PV ratio, straight away I will reach my contribution. Current year sales is 60 lakh. So into 28%, I will reach my contribution. It will be how much? It will be 16 lakh 80,000. I also know that fixed cost plus profit is equal to contribution. So already I know my contribution, it is 16 lakh 80,000. In the question, the fixed cost is also given, which is 14 lakh. So can't I find out my current year's profit? Yes. So it will come to rupees 2 lakh 80,000. Moving further. Now, this is the profit which we need to maintain for the upcoming year with the deduction in the selling price by 10%. So again, we will apply the same formula but in a revised manner. Revised PV ratio is equal to revised contribution divided by revised selling price. Now, for that, I need to find my revised PV ratio. How to compute the revised PV ratio? See, we know the formula is what? Sales contribution divided by sales into 100. So to find out the contribution, the formula is sales minus variable cost divided by contribution divided by sales into 100. Now please note, if my sales is 100%, the reduction is by 10% is what they have proposed. So my revised selling price will be 90% only. So here I am taking 0.90, that is 90% means 90 divided by 100. Now, variable cost, to find out the variable cost, similar, because I am taking the sales in percentage, variable cost also we will take in percentage. Now see here, in the last, that is current year, my PV ratio is 28%. So what will be the remaining of out of the 100 minus 28%, that will be your variable cost ratio. So that will come around to 100 minus 28, which will be 72%. I am taking here as 0.72. Now divided by sales in 100. Now sales is how much? Revised sales, it is 0.90. So if you do that, I will get my revised PV ratio, it is 20%. So what we need to analyze here, please understand, the moment I decrease my selling price by 10%, my PV ratio is falling down from 28% to 20%. That is what we need to understand from this. Now going further with the solution. Now desired sales is equal to desired profit plus fixed cost divided by revised PV ratio. Desired sales will be how much? 16 lakh 80,000 divided by 20%, which is our revised PV ratio. Going further, how I am getting to 16 lakh 80,000? Please remember, my profit which I am anticipating is 2 lakh 80,000, and what is my fixed cost? It is 14 lakhs. So altogether it is 16 lakh 80,000. Applying it, I am able to find out my desired sales happens to be rupees 84 lakhs. So that sums up the question. Next, second question is an interesting question. Please mark it as important. It may come for the exam. For the reason, it is a decision making question. Now, an exporter, he is selling the clothes. Okay, and he is as of now earning the profit of rupees 1 lakh by making a sales, overall sales of rupees 12 lakhs. The selling price of one product it is given as 50, whereas variable cost per unit is 40. Now, if this exporter incur additional 3 lakh rupees, if this exporter incurs additional 3 lakh rupees, the variable cost per unit 4 rupees will fall down by 5 rupees, and my revised variable cost will become only 35 rupees. Now, if I do like that, however, I can't change my sales value, which is happens to be 12 lakh, because we have committed that 12 lakh rupees. Now, with this information, they are saying, if you want to maintain the same amount of profit which you have earned this year, and you can't change your sales value in total, what should be my revised selling price is the question. I hope the question is clear. If that is clear, let's start discussing the solution. Now, I have selling price, I have variable cost, I can find out contribution. Okay, but I can't find out my fixed cost. So we need to have a working for the fixed cost. So see here, I am given selling price is 50, variable cost is 40. My contribution per unit will be how much? 50 minus 40, it will be 10. No doubt. Now, units sold. How much I can find out? How I can find out? 12 lakh is the total sales volume, and the selling price per unit is 50. So 12 lakh divided by 50 allows me to find out number of units sold, which happens to be 24,000 units. Next, 24,000 into 10, I will get my total contribution, which will become 2,40,000. Normally, from the contribution, if I deduct fixed cost, I will arrive at the profit. But in this question, they have not given me the fixed cost. But yes, they have given me the profit. So the fixed cost will be here, the balancing figure. So profit in the first line itself, they have mentioned it is 1 lakh. So 2,40,000 minus 1 lakh, 1,40,000 will be my fixed cost. So we have found out the fixed cost. Now we can continue doing the problem. Next, since I have fixed cost now 1,40,000, let us try to find out the revised selling price. Yes. So desired profit is how much? 1 lakh is what they have to maintain. Now, to find out the selling price, we are just doing the opposite way of preparing your marginal cost statement. Generally, we start with sales minus variable cost contribution. Contribution minus fixed cost, we will get profit. Here we are starting the opposite way. Desired profit is 1 lakh. Now, what about fixed cost? Current fixed cost, it is mentioned how much it is. It is just now we've computed this is 1,40,000 plus we will have an additional fixed cost of 3 lakh. So total fixed cost becomes 3,40,000. So what is my desired contribution? Fixed cost plus desired profit, which is how much? 3,40,000. 3 lakh plus 1,40,000 plus 1 lakh. It will be 5,40,000. Next, sales. They said you can't touch upon the sales. Your sales value cannot be changed. It should be 12 lakh itself. Fair enough. So now sales minus variable cost is contribution, means sales minus contribution will be my variable cost. So my restricted variable cost, that is I can't go more than that. How much is that? 12 lakh minus 5 lakh 40,000. It will be 6 lakh 60,000. Now variable cost per unit also I can find out revised. Why? Because earlier it was 40, but because I incur additional 3 lakh rupees, my variable cost will fall down by 5 rupees. So it will become how much? 35 rupees. Now, if it is 35 rupees, if I divide total variable cost divided by 35 rupees, I can find out number of units. So 6,60,000 divided by 35, it will give me 18,856 point something or 7 units we will get. Now, what is our main question? To find out revised selling price per unit. I can't change my total sales value, which is 12 lakh. So 12 lakh divided by 18,857 units allows me to find out the revised selling price, which turns out to be 63.64. So with this, the second question is also over. Now, moving at third illustration, which is given. It was supposed to be a beautiful problem. However, there is a small mistake in the question. Let's look into the question. They are asking us to find out the break-even point for a bus journey. Please note, for a bus journey, which is happening from Hyderabad to Chennai. Now, fixed cost of the bus, that is obviously the purchase cost is 1,50,000. Now, here they have made a mistake. This is what I understand. Cost of each seat is given, which is rupees 5,000, which is mentioned. So, I believe it was supposed to be cost of each journey to be 5,000. Why, I will discuss later. Now the bus capacity has 60 passengers, and from each passenger I will collect the ticket of rupees 400. Now the important line next one is there is no variable cost per passenger. If I interpret cost of each seat is rupees 5,000, automatically depending on the number of passenger, it will keep on fluctuating. So it will again become my variable cost. So I can't consider it as cost of each seat. It should have been cost of each journey. If that is true, I can find out easily break-even point, which happens to be per seat ticket collection is 400, number of seats is 60. So 40 into 60, it would have been 24,000 rupees. Now, cost of each journey. So see, what is 24,000? Total collection from one journey. Now, total cost from one journey, if it was given properly in the question, it would have been 5,000. That can be variable. Number of passengers, variable cost per passenger, they say agreed. They are saying there are no variable costs, but variable cost for a journey can be there. So in that way, 24,000 minus 5,000, I will have a contribution of 19,000 rupees. Now, what about the fixed cost? I will consider 1,50,000 only as fixed cost. So my break-even point for one break-even journeys, I can say break-even point will be 1,50,000 divided by 19,000. So this particular bus, if it makes 8 journeys, then only it will reach its break-even point. This is what we need to understand. Moving to the next illustration. It is talking about that they are asking us to calculate the break-even point and the turnover which is required to earn a profit of 50,000 from the following data, where they have mentioned fixed cost is 2 lakh, selling price is 35 and variable cost is 5. Currently, the company is earning the profit. They are also asking us to find out margin of safety. So let's write on the formula. Desired sales is equal to desired profit plus fixed cost divided by PV ratio. So for that, I need to know first PV ratio. Let's try to find out the PV ratio. What is PV ratio formula? Contribution divided by sales into 100. Okay. So selling price is 35, variable cost is 5, my contribution will be 30. So PV ratio will be 30 divided by 35, it will come to 85.71%. Now since I have found out PV ratio, I am applying desired sales is equal to 50,000 is my desired profit, 2 lakh is my fixed cost divided by 85.71%. My desired sales will come out to rupees 2,91,681.25. Now, if I want to find out in units, straight away 2,91,681.25 divided by selling price of 35. If I do, I can find out the answer. Or alternatively, what I do, I'm revising the same formula. Only thing is, instead of using PV ratio, we will apply contribution per unit. So 50,000 plus 2 lakh, as you can see above, divided by, instead of 85.71, we are applying 30. So I will get 8,333 units. Even if you do 2,91,681 divided by the selling price, that is 35, still you will get the same answer. Okay. Moving further. Now, sales to earn the profit of 50,000. Here, we have one formula, which is margin of safety sales is equal to profit divided by PV ratio. So, I do have the profit, I do have the PV ratio also. So, profit is given is 50,000 and PV ratio we have computed 85.71%. So, if I do that, I can find out margin of safety. Margin of safety is 58,336 rupees. It means what? It is the additional sales beyond the break-even sales which will result in my profit of 50,000. So if somebody asks me what is the additional sales to earn the profit of 50,000, my answer will be what? 58,336. Now what is the sales, entire sales volume to achieve this 50,000 profit? Where we need to find out your actual sales. Actual sales, there is another formula. What is that? Break-even sales plus margin of safety is equal to actual sales. Because we do have another formula for margin of safety is equal to actual sales minus break-even sales. So break-even sales is fixed cost by PV ratio. Fixed cost is 2 lakh divided by 85.71. I get 2,33,345. So 2,33,345 is my break-even sales. So that plus 58,336, I will get my actual sales, which should happen, so that I end up in finding out my profit of 50,000. Now, another way of doing is, actual sales will be sum total of everything, okay, which I just right now mentioned. Margin of safety sales is equal to 2,91,681 minus 2,33,345. It is 58,336. Again, a confirmation of what we have done with the other formula, which is profit by PV ratio. That's it. So with this, the problem comes to an end. Now, next is a question. Again, it can be considered as an important question for exam. This question is based on the concept of indifference point. Here there are two companies are there, A and company as well as B and company. Both the company's sales data are given, variable costs are given, fixed costs are given separately. They are asking us to find out what will be your sales volume where A and company as well as B and company will be same. That is, they both are indifferent. That is, a particular sales volume will be there where A and B and company both are same. So what is the sales volume is what they are asking. Second question they are asking, if the firm is likely to earn greater profit, which company will you choose? And if there is a low demand of the product, which company will you choose? So these are the questions before us. So first let us try to find out the indifference points. So indifference point, the formula, one of the formula, there are four formulas we can discuss. However, here it is relevant is change in fixed cost divided by change in PV ratio. So let's first find out these things. Sales, given the question, 5 lakh and 6 lakh respectively. Then variable cost is given 4 lakh each. Contribution, I can find out 5 lakh minus 4 lakh, 1 lakh and 2 lakh respectively. PV ratio, can I find out? Yes, contribution by sales into 100, 1 lakh by 5 lakh into 100, it will come out to 20%. For the B and company, it will be 2 lakh by 6 lakh, 1 by 3, 33.33%. Fixed cost is also given, which is 30,000 and 70,000 respectively. Can I find out the breaking point for my interest sake? Yes, I can find out. That is fixed cost divided by PV ratio. It will be how much? 1,50,000 for A and company and 2,10,000 for B and company. Now, indifference point we can find out. Change in fixed cost. How much is fixed cost varying for both the companies? For one company it is 70 and for another it is 30. 70 minus 30 it is 40,000. Okay. Now what about the change in PV ratio? For one company it is 33.3% and the other company it is 20%. So 33.33 minus 20%, which will be 40,000 divided by 13.3%. So my indifference point is 3 lakh. Now how to ensure that it is true? Let us see. At the, I am writing here A and company, B and company. The sales is 3 lakh for each company. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. What about the variable cost? For this company, it is AN company, it is 4 lakh. 1, 2, 3, 4, 5. Okay. Now here, sorry, here I need to find out the revised variable cost. So 4 lakh is variable cost for 5 lakh. If that is true, for 3 lakh is how much? Because variable cost per unit is constant, but it keeps on changing with the number of output. So 4 lakh divided by 5 lakh into 3 lakh. So it will be 2 lakh 40,000. It will be 2 lakh 40,000. Similarly, can I find out for the BN company also? So it will be 4 lakh divided by 6 lakh into 3 lakh. So it will be 2 lakh. It will be 2 lakh. So balance here it will be 60,000, which will be our contribution. Here it will be 1 lakh. Now let's write fixed cost for AN company, it is 30,000. For BN company, it is 70,000. So what is my profit? It is 30,000. Here also it is 1,000. Hence it is proved. So by applying this formula, what will happen? We are coming at a stage where both the companies are making the same profit, or both the companies are working on the same line. Both the companies are equal. So this is what I want to appreciate in this discussion. So this is the concept of indifferential point. Okay. Next, second and third part of the question. They are saying, first case, that is the second part of the question, they are saying if the firm is expected to have heavy demand, okay, which firm will you choose, AN company or BN company? See, when there is immense demand, I'm not bothered about breaking point, because I am definitely will meet my breaking point. So the idea will focus will be where I will earn, under which option I will earn higher profit will be the basic idea. Now, AN company makes the higher profit or BN company? The company which is having the higher PV ratio. Given your fixed cost remains the same. If in this case, that if that to be true, where is the PV ratio higher? Under BN company, it is higher. So what is your answer? So if the demand is unlimited, I would rather go with the BN company. So that is your first part of the answer. Now where my demand is constrained or limited, my focus is on what? Somehow let me try to reach my break-even point. So where is my breaking point lower, that one I will choose, which means what? Where is my fixed cost less, least fixed cost, which in under which option I will choose. So here the least cost option is where it is on AN company, that is 30,000. So my answer in this case will be AN company. So with this, we come to the conclusion of the illustration 5. Because it is a management accounting is a subject, decision making and the logic behind the decision making may ask. So I would rather say this can be an important question from the exam point of view. Okay. Thank you very much.